All right, I think we can kick off. Hello, everyone, and welcome to this webinar about the Apollo Crypto Market Neutral Fund. I'm Henrik Andersson. I'm the founder and chief investment officer at Apollo Crypto. And today we are joined by Won Ying Ng, portfolio manager for the Market Neutral Fund. Hi, Won.
Hi, everyone.
The purpose of this webinar is to inform everyone, our investors and followers, and to provide general update on the crypto markets and our funds. And as a reminder, this is general discussion and not to be taken as financial advice. Please do your own research when considering an investment in the crypto markets. For anyone new, Apollo Crypto is a multi-strategy investment fund. We are based in Melbourne, Australia, and the BVI, and we invest globally. We have more than 7 years of successful track record, and we have 3 active funds. We focus solely on managing crypto assets and strategies on behalf of wholesale, accredited investors, family offices, and fund of funds. This webinar will focus on the market neutral fund, as we are getting a lot of questions about the fund. The returns have been very solid, but I think there's a lack of understanding how returns are generated and how risk is managed. That's something that we'd like to address in today's webinar. And as always, we're happy to take questions. So please submit any questions as early as you can throughout the webinar, and we'll get to the questions at the end of the webinar. So with that said, I'm going to share my screen. All right. So we are talking about the Apollo Crypto Market Neutral Fund. It's a fund that we have been managing since 2020 for 4.5 years. And the opportunity here is really what we call the on-chain economy, the growth of decentralized finance on the blockchain. So these are things like stable coins, which is growing very, very rapidly. There are over $200 billion outstanding in stable coins today. We think that could grow to over $1 trillion in the coming years. We talk about the measure called TVL, that's the money locked on blockchains. That's today over 100 billion, excluding stablecoins, and that is growing rapidly as well. Another metric is decentralized exchanges. So those are trading that takes place on blockchains instead of centralized exchanges. And that is growing very, very rapidly as well. Right now, the most popular DEX is called Hyperliquid, and they're doing billions and billions of dollars in trading every day. So this fund really sees on the opportunity of the growing on-chain economy. It's what we call an on-chain fund. We're trying to minimize counterparty risk and allocate capital on-chain where this opportunity exists. So really, we'll get into what we're actually doing in the fund to generate the returns. But we are basically on a high level taking advantage of the inefficiencies that exist within crypto markets. And those inefficiencies exist there because of complexities. It's not easy to operate on-chain. We work mainly with stablecoins to protect the principal in the fund. So that's why we call this a market neutral fund. It's what we call a non-beta exposure. So it's not a crypto exposure per se, but it takes advantage of inefficiency that exists in crypto markets. And since inception, the returns have been really solid for the fund. The average monthly return for 4.5 years has been 1% on a monthly basis. Start ratio 1.34. standard deviation. So this is the volatility analyzed for the fund since inception is 6.2%. So much lower than crypto. Bitcoin volatility is maybe 50% or higher. Your typical equity fund is maybe 15 to 20%. So this is far below that. The number of positive months since inception has been 92%. And in fact, more recently in the last 12, 18 months, it's been 100% positive months. So we got an impressive track record with this fund. But again, this webinar is really to explain what we're actually doing in the fund to achieve these results, and also to explain the different type of risks in the fund and how we manage that. So we have two main strategies to generate the returns in the fund. One is yield farming, and the other one is called funding rate arbitrage. And why don't you try to explain these strategies to the audience, starting with yield farming?
Yep, no problem. Hi, everyone. I understand that yield farming is a very confusing term, and we get asked a lot of questions like, what do you actually do when you say yield farming? So essentially, decentralized finance is enabling anyone to perform roles that are traditionally performed by banks or market makers or brokers. So for example, yield farming enables people to market make instead of just relying on market makers. So one example is in decentralized exchange, people could provide liquidity. So for example, the top two stablecoins are USDC and USDT. When we provide USDC and USDT into the smart contract, millions and billions of volume go through it, and we harvest fees and some incentives provided by these decentralized exchanges. So how is this different from traditional finance? Traditionally, if you're trying to buy stock, you need someone to sell it. And it's usually performed through a brokerage platform. And the broker has to go to a register to change the ownership of the share. But in decentralized finance, because everything is recorded on chain in the blockchain ledger, and we don't need that. That's the power of tokenization. And the other example is lending. So we have lending protocol where people can pledge Bitcoin or USDC, USDT stablecoin or Ethereum, and they can borrow other crypto tokens. So for example, if someone has some Bitcoin and they want to buy a house, they can provide Bitcoin to a lending protocol, borrow stablecoin, and convert it into whatever currencies that they need to buy a house. And people that provide stablecoin in return can make some borrow return from these transactions. So again, that demonstrates the power of tokenization. So it's actually fairly simple, and I think yield farming is complicating the operations. It's just very similar to traditional finance. And some other examples where we perform some more complicated strategies is we assess some new DeFi projects. So we call it a pre-deposit program. So when a DeFi project launch, so for example, like a new blockchain or a new lending protocol, it's not going to work if they launch day one and there's no liquidity in there. And we usually go talk to these founders, assess what they're trying to do and what sort of incentives we can get. And we provide day one liquidity. And we usually get these returns in the form of the project tokens, which we can harvest when they launch their project one day and launch their token one day, and we compound back into the fund. Next slide, please.
Yeah, great. And remember to put any questions in the Zoom chat as we go along.
Yeah, and then we have this more advanced strategy called funding rate arbitrage. So for example, on Hyperliquid, it's a platform where people can bet on Bitcoin or Ethereum to go up 2x or long or short 10x even. So when people try to long Ethereum in an up market like today, they have to pay something called funding rate. It can range from anywhere between 0% to 100% depending on market condition. And we look at this funding rate and we come up with a strategy. For example, in an up market, we might buy Ethereum on decentralized exchange and hold it in our wallet. and then we'll short Ethereum on Hyperliquid and harvest the funding rate, which could be quite lucrative. Like, if we're doing a 1x is 10, 11%, for example, 2x might be 22%. So we monitor the market condition quite closely to perform these strategies. And on the other end, we might even yield farm or provide the Ethereum that we hold in a liquidity pool or lending protocol, like what we explained in the last slide.
Yeah, great. So I guess when it comes to both the strategies, one kind of differentiating factor is that you don't really take counterparty risk. These platforms are automated with smart contracts when it comes to liquidations and lending and all these things, right?
Yep.
All right, let's move on to the risk section, which is obviously important.
Yeah. So the first risk is being able to identify you across DeFi, because we've been operating in the space for 4 to 5 years now. So usually we tap into our network to identify early opportunities, for example, like the pre-deposit program that we talk about. We always know about the new projects that are launching very soon firsthand. And why are these projects offering us these opportunities instead of just opening it to everyone? Because we usually introduce other partnership within our network to the project to expand their network within the DeFi sector as well. And then they also know that because we're in the sector for a very long term, so we'll be able to provide liquidity for a longer time than some retail participants. And we're able to give them very good feedback about how they can grow their total value lock. And completing a security analysis. So like what Henrik said just now, of these opportunities, one of the main risks is smart contract risk, right? Because DeFi is permissionless, all the transactions go through a smart contract. So we need to be able to check if the smart contract is relatively safe. So what we look at usually is look at smart contract audits provided by the DeFi protocol. So we've looked at this smart contract a few times. We have a good idea of what smart contract is safer and what's the function that they have and what smart contract might be riskier. And we also go on chain to verify the reserve asset of a protocol. So for example, for a stable coin, when we hold a stable coin, we usually go on chain to verify that what sort of backing that they have and understand what sort of mechanism they are running for this stable coin. So while holding asset on chain, so there are a few different wallet infrastructure. So most people just hold in a hot wallet, and then we have cold wallet, and then we also have institutional custody. That's what we're using today. So we use Fireblocks and 4DeFi. So this custody actually require multi-signature signing, so no one can just get compromised and lose the asset one day, because we can set up 2%, 3%, or 4% signing, and also customize what sort of functions we need more signature. And within this custody solution as well, it shows us some simulation of transactions. So let's say if I'm swapping 100 USDC to 100 USDT, this wallet infrastructure actually show you your outcome before you sign a transaction. So with our experience being in the space for 3 to 4 years, so we are quite good at monitoring the position and risk. So we run a very diversified portfolio where we try to deposit and manage our exposure to one single pool or smart contract. So at today, I believe we have between 10 to 20 different positions within the portfolio. So we have a real-time position monitoring where we look at our portfolio and exposure on day-to-day. And in some case where our exposure might get too much because the yield is just too attractive, we also buy some smart contract insurance to hedge the position. So we do daily harvesting of token rewards as well, like what I explained just now. So when we get a project governance token, when project offer extra incentives on top of trading fees, we harvest the token and compound them back into stablecoins and grow the portfolio.
Fantastic. So I guess most exposure probably is USDC, is the biggest stable coin. But how do we kind of assess if a stable coin is safe or not?
Yeah, so the top two stablecoin is USDC and USDT, right? So they are generally assessed as safe. And then on top of that, there's some real world asset backed stablecoins. So for example, RWA, stablecoin backed by T-bills. This is when we talk to the team and understand what sort of compliance project that they've been through, do our due diligence, and what sort of where is the T-bill held. And they usually go through very stringent compliance process, and their T-bill is actually held with a very reputable provider in the traditional finance space. And then there's some more exotic stable coins where they run strategy backend, like the funding rate arbitrage as well, where we can actually go on chain and look at their portfolio and see if they are properly hedged and they actually hold the assets that they claim that they hold.
Yeah, so it's important to look behind the scenes, what's actually going on, what's backing the different stable coins. So that's part of the work we're doing. All right, let's move on. So performance and risk metrics since inception. Yeah, so coming back to the numbers we talked about before, 1% monthly returns. I think that's a really good average. 92% positive months since inception. A very low, I would say, standard deviation. And the target return, and we'll get back to that as well, is 15 to 20% per year. And I think we are on track to reach that. For this year, last year, after fees, we returned 17.2%. The team, you see myself, and Won is the most important person for this fund, as she is the portfolio manager. All right, before we go to Q&A, yes, the terms and service providers for the Apollo Crypto Market Neutral Fund is a US dollar fund. So it's a BVI fund, and it's US dollar denominated. Minimum investment amount is 100,000. We do accept both dollar investments as well as stable coins. The liquidity is monthly, which means that if you're an investor in the fund, you will get a monthly statement from us. And you can also do applications on a monthly basis, and we also process redemptions on a monthly basis. With redemptions, there is a 30-day notice period, and there's a management fee and a performance fee of 2 and 20 with a high watermark. So pretty straightforward. As Won mentioned, we use Fireblocks and for DeFi, which is, I think, the Go-class custody standard setup for a fund like this. For Medium is the fund admin, and the fund is audited as well. So that's is the end of the formal presentation, and hopefully there are a lot of questions from the audience. All right. So I think we got 5 questions, so please put in more questions as well. If there's anything you wonder about the funds. Maybe Won, do you want to take some of them? The first question is, what's your AUM? Or are the redemptions in your fund treated?
Yeah, so our AUM is 15 million, and the redemption, it's a monthly redemption with a 30-day notice, and we do net asset value calculation at the end of each month. So for example, if a redemption is submitted today on the 29th of May, and the 30 days notice would fall on, let's say, 28th of June, and it would be considered a 30th of June redemption. And the once the 30th of June redemption, 30th of June net asset value is finalized, the redemption will be paid out in July.
Yeah. Cool. Adam Newton is asking about the distribution of returns. So this is not a yield fund as such. the returns are accumulated. So all the returns are reflected in the NAV and the monthly NAV that we report to investors. And it's a BVI fund. So I'll keep that in mind. And yeah, we can't give tax advice. Anything to add to that one?
Yeah, we're a BVI fund, so you have to get tax advice from your, respective country tax advisor, because yeah, BVI, we don't issue a tax statement. So yeah, the tax dealing has to be dealt with depending on which countries you're based.
Yeah. For some investors, it's tax advantageous not to pay a dividend, as you don't realize an income, but that's the individual situation for each investor. All right, we got a question from someone else, anonymous, asking, there's been a handful of months that were negative over the past 4 years. What was the cause of those negative return months, and how likely it is that it could happen again? So I think we show that return graph in one of the slides, and there was particularly 1 month where we had a negative return, and that was due to the Luna USD DPEG that month. UST was algorithmic coin. That's something that we are not including in the fund anymore. I think we have learned a lot since that episode. Curious to hear your take on that as well.
Yeah, so there was actually 2 negative months, and one of them was below -1%. And I think it happened very close to each other. I think UST happened, and then the other negative month happened. So the bigger drawdown that you see in the chart is actually from UST, and the other one is probably some secondary effect from that, which is less than -1%. So yeah, UST happened, and I believe a lot of funds and a lot of even retail investors are affected by the collapse of UST. But yeah, as always, we try to manage the risk over there. We manage our exposure, and that was how we contain the loss to less than 10% of the portfolio.
Yeah, I think it goes to our risk management that we didn't have a bigger loss, and also a lot of learnings for ourselves as well. The dangers of algorithmic stablecoins. So, what about negative returns in the future? Of course, we cannot promise anything or guarantee anything, but we do run solid risk management in our view, and we run a diversified portfolio, and we think the risk reward look very favorable over time for this fund.
Yeah, we try to run our strategies quite widely. So if we see some very attractive opportunities, we would allocate some of that to those opportunities, but we also look at the risk at the same time. So there's no time where we would actually go all in into one opportunities, and those sort of stuff would never happen. But because higher risk opportunities are usually higher return, so we could be seeing something like like 20-30%, and then lower risk opportunity, we are currently looking somewhere around T-bill rate, maybe around 5%. So with all these opportunities that we're in, so we kind of get what we're seeing in our monthly report, so we sort of land around there.
Another good question from Adam Newton. As these markets become more efficient, mature, do you expect a reduction in the target returns? Yeah, so the current target return is 15 to 20%. That's what we think we'll achieve over a cycle, over time. Obviously, it will go up and down. And I would say it's correlated to the sentiment in the crypto market. So even though we aim to achieve a positive return in all market conditions, the level of returns we can achieve within the fund is definitely correlated to the sentiment in the crypto market. This year, we will we believe that will be inside that 15 to 20% range for the fund. And over time, over a cycle, we think that we'll achieve that. But of course, as the market matures, some of the low-hanging fruits might not be there. But there will always be a lot of innovation, I believe, in DeFi, in crypto. So there will always be new opportunities that are open to us. It's an ever evolving and changing market. So maybe some of the easier returns will be gone when the market matures, but there will always be opportunities out there.
Yeah, agree with what Henrik said, but interestingly, I had this thought since about 4 years ago. Surely, these returns are not going to last. It's just so good, so lucrative within the DeFi sector to be able to achieve this return market neutral. But 4 years in, and we're still running and we're still seeing opportunities. I think it's more important to adapt to the market. The way that yield farm works has evolved over time. So like in the past, we provide liquidity, we market make, we get incentives, and these days, and we are starting to see some newer trend like the pre-deposit program that we talked about. So in the past, projects usually just launch and then they have liquidity and have assets allocated to it, and then they sort of have to wait for the market to play out. And then over time, these projects sort of learn that if they launch with, let's say, 100 million in TVL, it actually works better for them.
Yeah. What is the watermark? So maybe we want to explain what high watermark is. So high watermark means that we only charge performance fee where you are above a previous high in your NAV. And this high watermark is individual per investor. So there is no fund level high watermark. It depends on when a certain investor invested in the fund. Smart contract insurance, that's a good question. I think you touched on the subject one when it comes to risk management and how we use smart contract insurance. Can you expand on how it works?
Yeah, so how smart contract insurance works essentially is quite similar to how traditional insurance works. So there are people, for example, Ethereum holder or even USDC holder, they can go into a smart contract protocol. So what we're using or what's the biggest smart contract protocol right now is called Nexus Mutual. So they can take stable coins or Ethereum from anyone, and then they work on assessing the risk of a smart contract. So for example, maybe this very simple stablecoin protocol, they insure against the risk of it depegging. So for example, they insure against USDC depeg. So if they assess that the risk is quite low, and then they would provide a quote, right? You can, let's say, buy USDT depeg cover for maybe 3% per annum. Yeah, so this liquidity provider in this smart contract protocol makes money through smart cover purchaser like us.
Yeah. Cool. And when there's a really good opportunity out there and we want to take a larger position, we can use insurance to be able to do that. All right. And Victoria is asking, in which situations will redemptions get gated? What could cause it? Examples? Yeah, so the fund is almost all liquid, consisting of stablecoins and different stablecoins positions. There are some rare cases where we lock up stablecoins to increase returns. Those lockup can be 1 to 3 months, but it's only a small portion of the portfolio. So I don't see situations where redemptions would be gated. And then Victoria is also asking, what's the minimum hurdle rate for performance fee? The fund does not have a hurdle rate. And then we got a question about max drawdown and Sharpe ratio. So Sharpe ratio, I think we talked about. So since inception, and that's December 2020, Sharpe ratio is 134. So that's really good. And actually, in the last 12 months, the Sharpe ratio is 7.4%. So really outstanding. And max drawdown, I don't have that number on top of my head. But that will be around the Luna USD DPEG.
You want me to look it up, Henrik?
And that would be around, I would say, 9% or so over those 2 months, roughly 9 to 10% perhaps. So that happened in 2022. Okay, we got an interesting question from Peter Gans. Are you integrating any AI tools? Do you want to talk about AI and the potential of AI for what we are doing in the fund?
Yeah, definitely. So at the moment, for me personally, I'm mostly using AI for research. So we don't use AI to execute, and we don't really use AI in yield farming specifically, because we don't really trust it being able to execute it perfectly yet. One day it might. Yeah, but it's not our position to develop these tools, so we're hoping someone can perfect these tools and one day we can use it. But in terms of research, when researching a protocol, it's very useful to use AI, and then we can look up all sort of information, but always also going into the source to verify that those information are true.
Yeah. We're starting to see some protocols as well, starting to automate optimizing yield with AI, but also mainly more simple strategies and not the advanced strategies we're doing in the fund.
Yeah, also one of the latest AI tool I just remembered that I've been using is like a AI's governance tool. So crypto projects, sometimes they run as a decentralized autonomous organization, and then all the changes within the protocol, they have to go through what they call governance. So with that many projects out there, sometimes it's hard to follow through what's going on. So for example, the biggest lending protocol is called Aave. So they have lending, they have governance to increase capacity, or they might make changes to the interest rate mechanism over there, or they might decide to incorporate new collateral, which might actually be very good for our fund. So there's some AI governance tool that actually aggregate all these governance changes.
Yeah. All right. We got anonymous attendee asking how long is the cycle for this fund. So I did mention the target return of 15 to 20% across the cycle. The cycle in crypto we refer to usually is a 4-year cycle. That's what we've seen in the past. But what we are talking about is across a bull and a bear market. All right. Any concerns on recent hyperliquid jelly incident? Understand the protocol has upgraded risk management. Juan, do you want to talk about that one? There was some liquidations on Hyperliquid. I think the liquidation engine did work, and the vault backing Hyperliquid, all this sort of very minor
Yeah,
hit.
so a summary of what happened there is a liquidity management issue. So Jelly is not a very deep liquidity token back then. And then when Hyperliquid listed it, they took a position too large, and it wasn't possible for them to fully liquidate it when the price changed by too much. So the people that got affected was people that provided liquidity in this Hyperliquid token called HLP, which automatically allocate liquidity throughout the Hyperliquid pairs. So when we assess this sort of risk, right? So first example would be Hyperliquid. So Hyperliquid, we know that they have good packers, they have good treasury, they make a lot of money. So in this case, Hyperliquid actually compensated all the affected people in there. So we need to also be able to understand that, what's the worst case scenario and what would the team do about it. Any other concerns about Hyperliquid at the moment? Yeah, not that I could think of, but Hyperliquid does still have its centralization risk. yeah, I believe they're still running on a few multi-sigs. The team are all known, so it's not like there is some anonymous person. Yeah, but always manage the exposure on Hyperliquid and always just understand that what sort of exposure that we have over there.
Yeah, we got one question as well from Peter about the Frontier Fund and primary projects and the current cycle. And I would say the Frontier Fund is a very different fund than what we're talking about now. It's a fund that is directionally long, focusing on what is called altcoins, so crypto assets outside Bitcoin and Ethereum. And we're mainly focusing on liquid assets these days, not so much new ventures, new primary deals. We think the market actually is warming up a lot for altcoins at the moment. And we are running a very diverse, very concentrated portfolio of altcoins that are generating a lot of revenue. So we are very bullish on the Frontier Fund and what we're doing in the fund and the current strategy. And we think this is the time to invest in liquid altcoins to harvest the returns in the coming months and years. All right, we got one more question about you, Juan. Just to clarify, you work for ACM International, which is the fund manager for the Apollo Crypto Market Mutual Fund. All right, maybe that's it. I think there was really good questions. Anything you'd like to add, Juan?
No, that's all.
Cool. So we hope to see many of you at our next webinar. And you can head to our website, apollocrypto.com, and you can sign up for our newsletter if you're not already a subscriber. And please get in touch with us and our colleagues if you'd like to invest in the Apollo Crypto Market Neutral Fund. So hope to see you next time. Thank you.